Hello and welcome to another edition of The Buck Stops Here. I'm Catherine Murray. The goal of my program is to provide informed, fact-based discussions about the matters that impact Canadian businesses, both large and small, the markets, and your money. Here to discuss all of that today is Myles Zyblock. He is the Chief Investment Strategist at Dynamic Funds. Myles, great to be with you and catch up with you. There's so much going on, so thanks so much for being with me.
It's really nice to be here. Thanks, Catherine.
Thank you. Myles, it's been an interesting week. You know, we do tape middle of the week and air on Sundays. And, you know, it's only been 3 days of this week, and we've seen the markets roil down 2% on Monday. Now we're seeing to find that the markets are pushing the fears of a contagion from a China property developer to the sidelines. I want to get your perspective on this. You are a global manager and chief investment strategist, so perhaps give us some perspective if you can.
Sure. I mean, you know, what's been going on in China is not just about the last week. It's been an evolution of regulatory crackdowns over the last, since I guess late 2020, and you know, some of it's been in the education industry, the technology industry, and the real estate industry, and they're trying in China to help a lot of these over-leveraged companies, let's say, right-size their balance sheets. And you know, caught in the crosshairs, I think, is a very large real estate conglomerate out of China called Evergrand, and you know, that's caught people's attention more recently. But let me tell you, if you just look at Evergrand's stock price, people have been on this story for quite some time. It just seems that it's, you know, caught the buzz lately. Now, Evergrand is an important company. I mean, I think it employs something like 200,000 people. It probably touches through all its different operating companies, probably impacts millions of Chinese laborers. So it's a big story in the real estate sector in China. I mean, they are in some trouble. The bonds for Evergrande are pricing a high chance that they default, the company. And you know, what's the size of that, or what's the scale of that? I think estimates place their liabilities somewhere around 313 billion US dollars. So it's pretty big. I mean, you know, Evergrande represents their liabilities represent about 6.5% of all the real estate liabilities in China. So it's sort of a big deal. Now just say who's on the hook for all this stuff. And you know, of that 313 billion, if you believe you believe their balance sheet, about $19 billion of that $313 billion is owed to offshore people like us. The rest is owed internally. So, you know, there's been a lot of financial dysfunction in China over this whole real estate story and the deleveraging. But it's really so far stayed well contained. I guess the worry over the last few days had been that maybe it would spread out, that the worries in the Chinese real estate sector would spread out. And it did start sort of impacting markets, but to a very small degree so far.
So that's fascinating in the sense that, well, a number of things, but one is that the risk or the liability is really contained within China as opposed to foreign investors. But if we think about why this would be happening to one of the biggest, presumably one of the better real estate developers, that would lend itself to ask, well, what about other players that might not be as strong as Evergrande, and what kind of risks might that impose? Why is this happening?
Well, look, I think it's, you know, I think the Chinese government is now starting to talk about common prosperity. They use this term quite a bit, and common prosperity to them means, part of what it means is to slow down the real estate sector, to help make housing more affordable for the Chinese citizens. And, you know, caught sort of in the crosshairs of this macro-prudential policy, caught in the crosshairs have been some of these over-leveraged real estate companies. So could it spread? I mean, it is. You know, there's other real estate companies in China that are under a lot of pressure. Their stock prices, their bonds, they're under a lot of pressure. But again, it seems to be, at least to this point, it seems to be sort of focused on the Chinese real estate sector and not spreading globally. Because like I said, unlike, for example, a Lehman Brothers back in 2008, where there was, you know, counterparty risk and intertwining, this is a little more simple. It's over a few over leveraged balance sheets. Most of it is a domestic problem in China. And over the last few days, I know you're taping the show, but over the last few days, we've seen the central bank in China start to inject a lot more liquidity into the system to try to calm down markets. So they're trying to handle their domestic affairs here, and that's sort of keeping it, at this stage at least, contained.
Yeah, and it's almost though the central government there obviously is the backstop. We're going to take a quick break, and we will be right back. Myles, we of course were just discussing that the Chinese government is basically the backstop. Is that right? So in other words, they can perhaps contain it, but give us a bit of a maybe the ripple effects that the market is also interpreting from the developer.
Sure. If you take a sort of a step back, what I think is happening is that investors around the globe are saying this is sort of a deflationary shock to the global economy. And so what do I mean by that? It's going to slow down growth. There's going to be ripple effects. There's economic effect. I guess the ways that, the Chinese situation can impact the economies and markets is through financial contagion, which so far seems largely isolated. But there's a general economic slowdown going on. And this is a little bit of a pile-on factor when you see China struggling a little bit. It's going to slow down economic growth in China, and that will sort of ripple out into financial markets in different ways. And for example, you see things like copper prices starting to struggle. China is a big consumer of copper. Iron ore has been, really pounded lower over the last few months. And again, China is one of the biggest, if not the biggest, consumer of iron ore in the world. And you also see it in some financial markets, the slowdown being priced, for example, the Aussie dollar. So the Australian dollar, we know that Australia has large export exposure to China, and you're starting to see that a little bit being priced into their currency markets. So you do see the ripple effects, but they seem to be controlled and manageable. And I think that's how it's sort of feeding into the financial market situation right now, is just through a re-rating of our growth expectations lower.
Mm-hmm. And so where does that leave you in terms of changing your expectations for growth in North America, whether it's Canada, because it's interesting, some of those areas of the market, the copper, whatever, has come down. WTI, though, has managed to stay at around that $70 plus level, but that's also probably because it has its own unique characteristics, which is there has been such an underinvestment over the past number of years. It's been under significant attack. So maybe that's the supply side that is holding it. But how do you see it playing out as it relates to the growth outlook for Canada and the United States?
So I think in North America, we're already, look, base effects alone, growth is slowing down in both Canada and the US because, it's hard to grow at 8, 9, 10% GDP forever. It's effectively almost impossible. So, we're taking a step back. Growth is normalizing back to trend. And I think, when it comes to the Chinese impact on the local markets here, I think it's a much smaller impact, a much smaller direct impact on America. America is still it's very large, but it's also a fairly closed economy. So trade as a share of its GDP is not very big. But Canada could feel a little of the ripples. Again, not to the extent that Australia would, but you might feel a little bit in terms of trade in the export markets a little bit. But I don't, at this stage, I don't think it's a big deal for North America at this stage. Yeah.
Okay. And I just want to ask one more question as it relates to China and where you as a team like to invest. There's been so many concerns about what the government is doing with regulation and what the United States wants to do in terms of saying that that Chinese companies listed in the United States, that there's not enough disclosure. How do you, we get through all of those details? It's very confusing to therefore know, do you actually want to have China exposure, or is there almost too much regulatory risk? People are very divided on this.
I'm of the opinion there's a lot of regulatory risk still. I think the Chinese authorities are very serious with the regulatory crackdown. This could be the early stages of something that's longer and more drawn out, again, to enhance common prosperity. You don't want too many billionaires in China. It just doesn't look good for the politicians. So that's kind of what they're doing. They're going after the capitalists in China. And that, to me is worrisome in the sense that I'm not really sure that it's going to be, a big fundamental game changer, but it's the uncertainty about what could happen that's weighing on valuations for a lot of the Chinese companies. So, for me, if I'm looking, interested in technology companies, I can stay away from China. There's a lot to choose from around the world. I don't have to be in China. So, yeah. So that's, for me, China's not entirely interesting at this stage. Even though, prices have fallen, valuations have improved, I still want to get more clarity on where they're going with this common prosperity mantra.
Okay, we're going to take a quick break. When we come back, we'll find out where you are investing, where you do see the opportunities. We'll be right back. And we are back with Myles Zyblock, Chief Investment Strategist at Dynamic Funds. Myles, it's so interesting to hear your take on China, what's going on there, and that there's just not enough clarity for you to, really invest significantly there right now. And I kind of sometimes come at it that I'm hedging my bets. I want a little bit of exposure to the second largest economy in the world. But I get it. There is a lot of unknowns there. And, when we take a look at North America, United States in particular, there's a lot more, I think, knowns. So, although the Fed is going to be speaking today at 2 o'clock, and we don't know what they're going to do. I don't know if that's obviously not going to change the way you invest. But actually, why don't I pick it up on that point? What are you expecting from the Fed? Is it priced into the market? What should we expect?
I don't think there's going to be any major surprises. I think they're going to leave, largely leave everything alone. They may tip their hat to starting to reduce their balance sheet before the end of the year. We kind of get a sense, all of us are sort of on top of that. They've signaled and messaged, and maybe that happens. I still think interest rate, hikes are still in a distant future. At least the way they're messaging and what they're talking about with, full employment and all this other stuff, they're not there yet. So, so I don't think there's going to be any big surprise out of the Fed this week. But back to China, I think you can get Chinese exposure indirectly without the uncertainty. I mean, you can focus on companies closer to home that have Chinese revenue exposure. So you don't have as much of the direct impact on of the domestic regulations on those Chinese companies. I mean, you can get it in a roundabout way. And that's maybe some of the ways to still stay connected, because China is a very important economy. There's no question about it. And you don't want to be naked, excuse the term, naked China. But I think you can do it in ways that are lower risk.
What would that be?
So like I said, invest in some of the companies that that aren't in China, but that have revenue exposure to China.
Okay.
So that's just one of the ways you can do it without having to, be on top of the Chinese regulators there or be next to them.
And are you thinking more commodity-like sectors?
Well, commodity would be indirect, for example. So, anything commodity-centric is an indirect play on China. Anything commodity-centric. I mean, they're the largest commodity consumer in the world still. Right. So yes. Okay. The other thing could be that, you have companies that do business in China. And, maybe it's not 100% of the revenue, but it could be 20% of the revenue. So you're kind of hedging your bets. Maybe 80% of the revenue comes from the rest of the world, 20% comes from China. So you still have some exposure there, but not as much as investing directly in a Chinese company.
Got it. And just to pick up on the Fed, I'm curious as to your expectations for inflation. Again, another very divided subject matter for market participants.
Yeah, I mean, inflation, look, it's running hot. It's running very hot. And, to me, it's not, what I think about inflation that matters as an investor. It's what, my perception of policymakers, what they think about inflation. And that's how you sort of game the system here. And, to me, as far as I understand it, Chairman Powell from the Federal Reserve is still very much focused on the fact that he thinks inflation is a transitory problem. Whether it's because of supply disruptions or whatever, he thinks it's going to over time work itself out. He doesn't see, longer term inflation expectations getting out of control. He sees wage inflation as not that threatening. And so, my sense is that as long as it keeps talking like this, I don't expect any interest rate hikes. It doesn't matter what my view of inflation is. It matters what the Fed's view of inflation is for financial markets. So right now, I think they've adopted the transitory sort of playbook. They haven't really swayed from that too much. And what that means to me is that, the front end of the curve is going to stay pretty anchored towards zero.
But if there is real inflation going on in the system, I mean, that could lead to stagflation if we've got lower growth and inflation. Are there certain sectors like that you are saying, you know what, Powell might be saying this, but this is reality, and this is where I'm going. These are the sectors and stocks that have pricing power. People are feeling it. Where are you kind of navigating the investment dollars?
So that's a great question. I think what you want to do here is, if you're thinking about hedging against some inflation risk, you want to take a little bit of a diversified approach. So yes, commodities, we're seeing a lot of them are up on a stick, not all of them.
Yeah.
But at the same time, you want to think about companies that are a little bit more insulated from, say, wage inflation, if that becomes the bigger problem, because we know that the labor market, there's shortages in labor. So that, I think it's a diversified approach.
Okay, Myles, we're going to leave it right there. We're going to take a quick break. We'll be right back. Myles, we were just talking about the importance of diversification, probably now more than ever, just given all the different dynamics going on. So give us your sense in terms of where you're overweight right now from an equity perspective.
Sure. So, when you're thinking globally, we're overweight equities relative to bonds. Typically, that seems to add value to portfolio positions when the economies are growing. They're still growing. Yes, they're slowing, but they're growing. The growth is positive. So, we're remaining overweight equities. Focused a little bit more on what I call quality types of equities. So what does that mean? That means, relatively low balance sheet risk, strong profitability metrics, reliable earning streams. So not super variable earning streams through time. In a slowdown, that's kind of where I feel you want to be, bird in the hand kind of idea. And so that leads me to a lot of American companies, but not only America. We're finding these quality companies in Europe and elsewhere. But like I say, if you wanted to, pin me to a geographic position, it's a little more US focused than not. In the fixed income markets, like I said, we're underweight, a little more biased to corporate bonds, and they've been holding up right through this Chinese financial stress. The North American or the non-Asian corporate bonds have been holding up pretty well.
And where does Canada fit in the strategy these days?
Canada's very, very small allocation. Again, it's harder to find what I think works best in this global environment, which is much more of a quality focus. I'm not saying there aren't quality stocks in Canada, but the fact is that when you have a global set to choose from, there's a lot of great companies around the globe you can find. So it's still a small allocation in the global portfolio. I think one of the big things that we've been working on for the last several years is increasing exposure to alternative types of investments, not stocks, not bonds, but something alternative like long short credit, long short equities. And the reason we're doing this is because if you look at the valuations for global equity markets and global bond markets, they're more expensive than at any time. At the same time, mind you, they're more expensive than at any time in the last 140 years. And so what does that mean? To me, that means that there's more embedded risk in the traditional asset classes than there has been in a very, very long time. So to diversify those risks, we want to look for alternative return streams, and that's what we've been doing.
So in addition, though, to kind of long, short books, what else within alternative investments are you looking at? I mean, are you looking at crypto?
No.
Okay.
No, that's much too volatile for my liking. And I, to be honest, I don't quite understand all of the makings of crypto. So I'm just staying away from that. I think if you're thinking, in more in my wheelhouse, but look at me, I'm old. More in my wheelhouse would be we do have some exposure to gold, very tiny, but some exposure to gold bullion as an alternative sort of asset that may be comparable or competitive to crypto. Not really, but sort of.
Okay. And just real quick here, in terms of sector exposure in the United States, what do you like best? What actually works in this environment?
technology, healthcare, some of the areas of consumer discretionary. I think the reopening trade is a little bit long in the tooth, so we're not quite in the reopening trade anymore, like the bricks and mortar retailers. We've sort of pulled back from that, but consumer discretionary, communication services. So those are the main areas of focus. We don't have a lot of focus in energy. We don't have a lot of focus in materials or utilities. So that's kind of where we are, is sort of tech, healthcare, and selectively in consumer discretionary stocks.
Got it. Myles, I only have about 20 seconds or so, but kind of just final words of wisdom to viewers, about the state of affairs and how to approach their portfolio.
So I think that, one of the things we don't want to do is look at the screens every day. That markets are bumpy. And just keep in mind that the economies are still growing. There might be some slowdown. They're still growing. And when economies are still growing, that, equities tend to do okay.
Okay. Myles, great on the timing front. You're a pro at TV. Great to see you. Thank you so much.
Great being here, Catherine. It was great being here. Thanks a lot.
Thank you. We'll see you soon. And that was Myles Zyblock, Chief Investment Strategist at Dynamic Funds. So interesting for me to hear his view on what's going on in China. Evergrand, the property developer there, he has such a wealth of knowledge. I've been interviewing him for years. So great to get his view, a seasoned pro of what's going on in China. Contained for now, but we'll stay on top of the story. Thanks so much for watching. We'll see you next time.